SpaceX is preparing for what looks to be the largest initial public offering in history, targeting a valuation of up to $2 trillion. The public conversation is entirely focused on the romance of colonizing Mars. But if you actually want to invest, the reality of this company is buried inside a densely packed 600-page S1 prospectus, a document the vast majority of retail investors will buy into without reading a single page. I represent Stewardship Finance Academy, and after spending years analyzing corporate filings, I can tell you that the legal and financial structures hidden in this specific document are incredibly aggressive. To navigate traps like these, you need to know exactly how to read the tape. We teach investors how to break down complex filings like a pro in our free SFA Stock Investment Masterclass, linked in the description below. The prospectus outlines a transaction where you receive the economic interest in the company's future, but all voting authority and board control remains strictly within the existing leadership structure. In a standard publicly traded company, the power dynamic is simple. Shareholders elect an independent board of directors, and that board oversees the CEO. Take Apple, where Tim Cook holds less than 1% of the voting power. External shareholders have the collective leverage to vote out directors who fail to do their jobs. This corporate structure was legally fortified after massive financial scandals like Enron. Congress passed the Sarbanes-Oxley Act in 2002, which specifically mandated that a company's audit, compensation, and nominating committees must be 100% independent to prevent management from acting willfully. But over the last 2 decades, tech giants introduced the dual-class share structure. By giving founders 10 votes for every share, leaders like Mark Zuckerberg weakened external shareholder leverage to protect themselves from Wall Street's short-term pressures. This org chart shows how far SpaceX deviates from even that standard. Elon Musk directly and indirectly commands 85.1% of the total voting power. Beyond that, the charter stipulates that he unilaterally controls 5 of the 8 board seats, meaning regular shareholders have zero say in the majority of the board's composition. Because of this absolute control, SpaceX uses exemptions to bypass standard independence rules. Take board director Antonio Gracias. He is the CEO of Valor, a private equity fund with tens of billions of dollars in related party transactions with SpaceX. Yet Gracias sits directly on the compensation and nominating committees. This creates a direct conflict of interest. That exact same compromised committee recently approved a massive performance-based stock award package for Musk, worth up to $200 billion if specific milestones are hit. The system of corporate checks and balances has failed at the design level. If management decides to dilute your shares or execute questionable acquisitions, your only real protection is the CEO's own self-restraint. Despite the governance risks, the company does possess a massive engineering moat. By achieving vertical rocket landings, they crushed orbital launch costs from $18,500 to $2,700 per kilogram, an 85% reduction. That launch capability powers their true cash cow, Starlink. The connectivity segment generated $11.4 billion in revenue last year, boasting high operating margins and over 10.3 million active subscribers globally. This line chart, however, reveals a critical risk factor buried in the financials. Starlink's average revenue per user, or APU, is steadily declining. Driven by cheaper international pricing and entry-level domestic plans, it fell from $91 to $81 and hit $66 in the most recent quarter. Subscriber growth must constantly outpace that shrinking pricing leverage. That becomes incredibly difficult when the Starship heavy lift program is simultaneously draining cash, burning nearly $1 billion per quarter in research and development alone. The core space business is a high-stakes race. They have to continually scale global internet subscribers to fund accelerating capital-intensive rocket expenses. Complicating that financial picture is the recent acquisition. In early 2026, SpaceX retrospectively merged the financials of AI and the social platform X into its consolidated statements, introducing a new narrative around building state-of-the-art AI computing clusters. This bar chart contrasts the engineering speed against the financial reality. They brought the Colossus data centers online in record timeframes, 122 days and 64 days, but it required $12.7 billion in capital expenditures, driving the company to a negative $14 billion free cash flow deficit for the year. To fund this, they executed a highly sensitive maneuver. The auditor specifically flagged a $20 billion equipment lease agreement. The funds for these AI servers were structured through Valor. the exact same private equity fund run by SpaceX board director Antonio Gracias. Tracking massive shifts in capital expenditures and identifying the real dangers of related party transactions is exactly the framework we teach. Check the link in the description for the SFA Masterclass to learn how to spot these red flags yourself. This merger changes the financial weight of the entire enterprise. The established margins of Starlink now support an AI division that lost over $6 billion last year while building speculative computing infrastructure. So why is a company with such absolute market dominance rushing to the public markets right now? The balance sheet provides the answer. They're sitting on $29.1 billion in long-term debt. If you look at this flowchart, the mechanics become obvious. In March, they signed a $20 billion bridge loan with their core underwriting banks. Under the terms of the IPO, the very first $20 billion raised from the public goes straight back to repaying those specific banks. It is not funding a human colony on Mars. If you are a short-term trader, the lockup period details are highly concerning. While Musk is locked in for a year, other major pre-IPO investors have a laddered release schedule starting early August. Expect massive insider selling pressure in the market through November. And if anything goes wrong, if the massive AI gamble fails, or if a related party transaction severely harms the company's value, the charter holds a final legal trap. Minority shareholders are contractually blocked from consolidating or bringing federal class action lawsuits. This IPO is a historic debt deleveraging event. It offers investors access to the dominant private space industry and a massive AI cluster, but does so within a structure where minority shareholders have no legal voice if the business falters. Before you allocate a single dollar to this offering, you need to arm yourself with real financial literacy. Join the free SFA Stock Investment Masterclass linked below and learn to invest based on the balance sheet, not the headlines.